Going to hand it over to Nikunj, who's in conversation with S. Naren, ED and CIO, ICICI Prudential AMC. Nikunj.
Well, when we talk about markets, risk-reward ratio, pockets of fear, greed, excitement and despair and all that and much more about value investing, gives me always a pleasure to bring on board S. Naren of ICICI Pru AMC to talk about the way forward. Naren, good morning. Thank you for joining us. So what is your view on the market? Where do you think there is fear and there is greed, or there is no fear and only greed right now?
There is no fear. Maybe there is no greed in banking and financial services, but there is no fear in the market. Every day there are blocks happening in stocks which are loss-making companies, and they go through smoothly. So there are QIPs, there are IPOs, etc. So there is greed in all aspects of the market. Maybe in financials, I would say there is no greed, but even there is no fear. But at least there is no greed there. That's the kind of market we are in at this point of time.
So, Naren, the grain of the truth here is that if there is more demand and less supply, markets would move higher. I'm referring to liquidity, not just DI, liquidity which is coming from pension funds, liquidity which is coming by direct retail, liquidity which is coming even by family offices. So what happens in this market where you know that valuations are trading above par, but the flow of liquidity will ensure that the downside gets protected?
See, I did a talk recently in Tamil Nadu Investor Association, and the topic was basically this. And we looked at earlier bull markets, and we found that this bull market resembled the '94 bull market, which also had huge liquidity component. And in that liquidity bull market, eventually supply did catch up with demand. And after that, you did have a crisis in Asian countries, which then later created a big fall. So at some point of time, supply will catch up with demand because most companies know that the Indian valuations are very high compared to global valuations. And I hope sensible multinationals and many other promoters will opt to increase supply at this point of time because they know that valuations in India are much above fair value. So I think we will see a number of multinationals selling in India. You will see a number of multinationals listing in India. You will see a number of promoters reducing their stake in India, and hopefully that will all lead to increased supply. And eventually that is the only way in which a liquidity bull market can come down. And if you look at the genesis of the market, this bull market, it started off from March 2023 when equity taxation became extremely attractive. And that is the genesis of this bull market. And we believe that that genesis is the reason for this extreme bull market. And that's how finally supply has to catch up with demand. If the Indian promoters and multinationals and the government does not do enough disinvestment, I think this bull market can go on. Initially, we tried to look at it like foolishly and looked at valuations and those kind of things. It hasn't worked because if we had looked at valuations almost 6 months or 9 months back, we felt that the market was fully valued. But we are left looking foolish at this point of time.
Then it's quite a coincidence that some of your peer sets are exactly indicating the same, that look, we are not in a very strong value or earnings driven market, we are in a liquidity driven market. Whether it is Kotak AMC or Birla AMC or some other smart old time investors, they are of the view that this is a liquidity driven market and you don't know how far it could extend. So do you think right now one should not be in a hurry to call the market top? Because if this liquidity is here and if this liquidity stays here for another 3 to 6 months, which it could, which may not, but if it does, then markets could be at different levels.
I think finally we have to look at it from the point of view of an investor. What is the point in calling a market top? I think an investor has to be very careful in deploying additional money. And if an investor is invested way back, that person can afford to wait to book profits unless that person is invested in extremely aggressive parts of the market. This is what we tell people, how to call the market top. I mean, that's a very tough task at this point of time. But I think the time has already come for people to be careful in deploying new money, because if all loss-making companies are able to raise money in QIPs and IPOs so easily, the time to deploy money carefully has already come. So, as ICICI Mutual Fund, we are trying our best to tell people follow asset allocation as the best way to deploy incremental money, and don't do any other form of allocation at this point of time.
You started the interaction with financials and you said that they are attractive, they are not cheap. Now, for financials to do well, economy has to do well, because financials are always a delta on economy. They are proxy to the economy. So the fact that you are bullish on financials as a category, does that mean that you're also bullish on the economy?
See, actually, you have to look at the genesis of the financials underperformance. The financials underperformance is primarily because of the FIs being overowned in that segment. And what happened was the benchmark for them, which is MSCI, had a very low weightage in financials. And they were very overowned. If you look at the period from 2021 onwards, they've been the only segment which has sold. So they were overowned that segment, and thanks to low weightage in financials in their MSCI index, and they've been selling. I think by the time November happens, the benchmark weightage in financials would have gone up substantially. So the key reason for the selling in financials comes to an end by November. So I don't think it was an economy issue. I don't think it was a valuation issue. It was an excess holding by FI issue, and that excess holding by FI issue is coming to an end. So that's one of the reasons why we are so positive on financials. The only challenge with financials being your most positive sector is it is not a defensive sector. It would be always good, like in 2007, we used to be positive on consumer staples and pharma when the market was very bullish, but those sectors are very defensive. So to be bullish on those sectors was very easy, whereas to say that you're very positive on financials is a little bit of a problem, because everyone knows it's an economy sector, it's a leverage sector. But this time, the real reason for the underperformance is FI selling and nothing else.
Naren, I'd like to draw your attention to what is happening to perhaps policy sensitives. And when I say policy sensitives, defense, railways, shipyard, they've been the poster boys so far. But now a subtle, not a subtle, but I think a disguised correction has kicked in. Most of these so-called policy sensitive stocks are down 15 to even 25% from the recent highs. Do you think the party or the happy hours in some of the policy sensitive stocks, is that over?
They were overvalued, and they were stocks which we didn't own in a big way at all, I would say, even in a small way. And, you looked at those sectors, they were all trading at 100 P and 120 P and all that trailing. So it didn't fit our thought process on valuations at all. So we don't know. We have to ask the investors in that segment what they felt when they were buying, rather than people like us. It is not that the companies were bad or something like that, but we could not understand those sectors actually. We have stayed away. So we have benefited in the last 3 months, but we got hurt in the year before that very badly actually by not owning them.
You've been bullish on domestic facing sectors, autos, cement. Let's talk about autos and cement. They both are parallel to what is happening to the economy. Now for autos, two-wheelers are doing well and four-wheelers are taking a back seat. A year ago, two-wheelers were not doing okay, four-wheelers were enjoying all the limelight. What is the right way of looking at auto? Because 2 years four-wheelers do well, then 2 years or two-wheelers do well.
I think these are all cycles which play. So, two-wheelers was a sector which had done very badly from 2019 to 2023. So it was ripe for a rally. If you look at entry-level cars, they continue to do badly all the way for the last 4 or 5 years. So at some point of time, there will be a pickup. Now people say used cars take care of entry level cars, but at some point of time they'll come back. So I think everything is a cycle, and in these cycles, if you manage to catch the point of maximum pessimism or cheapness in stocks, you'll make money, and that is our approach. And that's how in two-wheelers, in some of the stocks, we actually made good money in our funds. And when auto was doing badly, we did launch the transportation and logistics fund, and the investors in that fund made very good money. But today we are not. I mean, we are no longer in that cheap zone in auto at this point of time.
What is your view on this whole theory that private sector capex is not picking up? When I speak to industry experts, they are saying, yes, it is not picking up, but private sector is now moving towards semiconductor, manufacturing, automobile and EV. And they're unlikely to be spending a lot in making big buildings, constructing roads, or for that matter, buying a lot of cement. Do you think it's time to approach private sector capex differently?
Absolutely. I think my colleagues in the debt side tell me if any company wants to do capex today, they don't need to borrow from banks. They do a QIP and do the capex. So a conventional thesis is that private sector capex has to happen through borrowing from banks and all that. That has changed. People do now through QIPs. So, and if any company's capacity utilization is full, they are bound to do capex. So, if you look at the power side, there is huge capex happening. In renewables, huge capex is happening. So I think people, the invisible hand will happen. So, if people want to do capex, they'll do it. How they fund the capex is also dependent on what is cheap. At this point of time, if many sectors, the price to earnings is 70, 80, why would you not raise equity and do the capex? To expect that private sector capex has to happen through bank finance, it is not going to happen. It may happen through equities. And look at the capital goods price to earnings ratios of most of the companies at this point of time. That itself is telling you that a lot of capex is happening. It won't happen in areas where there's no growth. It will happen in areas where there's huge growth. And that's why I think the way people look at private sector capex, you can't look at it in a wholesale way. You have to look at it sector by sector. Is cement capex happening? Answer is yes. Is auto capex happening? Yes. Is EV capex happening? Yes. Is auto ancillaries focused on specific sector capex? It is happening? Yes. Is the entire power and transmission capex happening? Yes. So it will happen in specific areas, and some other area which I'm not talking about, maybe there won't be any capex happening because there is no growth in those areas. So that's how things will happen.
Naren, just like you identified telecom for our viewers that this was a sector where the intense competition intensity actually broke the back of some of the listed players, but eventually rationalization and logic has come back. Where else do you think right now there is a lot of mispricing on the upside and mispricing on the downside, where markets are taking an extreme view?
See, market today is in a very big bull market. So, to get that fear element and getting shares cheap is a tough task. But if you look at cement, for example, it is an area where prices have not gone up and there is a fair amount of competition. Paints is an area where a lot of competition is happening and margins are under pressure. If you look at any area where China is the supplier and you're competing with China, like steel, for example, in all these areas, I would say that prices are down, margins are down, but share prices are not necessarily down. So by chance, if share prices also come really down, they become fantastic opportunities. Otherwise, you have to keep thinking, is your margins going to mean revert? And you have to buy it anyway. You have to do it because you're not in that fear element market of 2018 or 19 and 20 that you're going to get shares at mouth-watering prices, that you get the combination of fear and prices being cheap. Now you will get fear and prices. You won't get prices being cheap. You're getting lower margins. Be happy with whatever the market is giving you as price and be happy because at some point of time, margins will mean revert in these sectors.
Naren, you've always been a believer of cycles. Over the years, we've interacted that with you, always emphasized that, look, whether it's equity, bond, real estate, everything follows the cycle. So if you have to identify some cycles for us, which are the cycles across asset classes currently are still 40 to 50% away from its peak, be it real estate, be it bond, be it equities, be it metals?
Nothing is close to 40 to 50%. To me, the equity cycle looked full, but I have gone wrong. I mean, that's the reason why we've been recommending asset allocation. We thought that the small and mid cap cycle is full, but again, we are seeing continued rallies. So I think the time has come. We are big believers in mean reversion, and based on mean reversion, we believe that asset allocation is the way to go. But we have seen that, if you look at consumer FMCG stocks till 2020, they kept outperforming. But in the period after 2020, in the next 3.5 years, they gave huge underperformance. So I believe, asset allocation is the best way to invest today. And for people who are investing in loss-making companies and those kind of things, I think they should actually introspect whether they're taking too much risk at this point of time. And that's why we are big believers in asset allocation at this point of time, because that is a way of limiting risk in investing in equity in these markets. And we are big believers in large cap over mid and small cap at this point of time. And we think that, this is a time when people have to focus on risk versus return. Focus less on return and focus on risk. And I think it's a challenge because if every month market goes up on a continuing basis, to tell people to focus on risk and not return is thankless actually. And we are managers of public money, not small amounts of money. So it becomes even more challenging for us at this point of time to explain to people that you have to focus on risk and not return. And that is a challenge that we are facing at this point.
And you've all been a practitioner of value investing, right? You said buy something below its intrinsic value, buy something which is cheap, buy something which offers a good entry point. So how does value investing work in this kind of a market when bargains are not there?
So that's why value investing is doing asset allocation today, not putting all your money in equity at one go at this point of time. Clearly, value investing is asset allocation. And if you look at it, if there are, if, for example, global fund limits were open, there would be an opportunity to invest globally at this point of time because there are many global markets which are cheap at this point of time. So I would say that asset allocation is the best mantra of value investing at this point of time. And the reason why in the last 1 year, wherever you would have seen a stock, you would have heard one word called asset allocation. Primarily because value investing today stands for asset allocation. Because barring banks, which at least are not costly, almost all other areas we can show you is no longer cheap at this point of time. That's why value investing has resulted in saying do asset allocation at this point. And that's what has become, and this is the challenge that we are facing. And the biggest problem in investing is not arithmetic. There are people who come and say, you said asset allocation 1 year back, and if I had listened to you and not invested in small and mid cap, I've lost. But the reality is investing is not arithmetic that you will get it right all the time. Investing is not something that you're going to get right all the time. You are going to make mistakes. Even the gurus like Warren Buffett have made multiple mistakes. So, we said asset allocation 1 year back, but still small and mid cap have outperformed asset allocation in the last 1 year. So that is a challenge for us, and that is what we'll have to do because finally we are managing public money. So optimizing the highest possible returns is not the goal of investing for us when we are managing public money, and that is what we have tried to do.
One of the schemes you manage is a value fund. It's got a AUM of about 50,000 crore, CAGR return of 20% 10 years. That makes it, you grow at 25% for 10 years, you 10x. You grow at 25% for 20 years, you 100x. So what happens to a value fund now, or a scheme which essentially centered around value?
So we've ended up having a lot of banks. If you study the history of the fund, we would have never had as much banks as we have today. If you look at it, we have higher cash than we ever had. We have one of the highest amount of large caps that we would have ever had. And we would have had stocks in that fund, which in the past we have not had, like some of the mega caps that are there in the fund. So these are some of the things that we have done. And if you look at the portfolio today and look at the portfolio 4 years back, the portfolio has changed drastically because of where the market is today at this point of time. And in the history of the fund over the 20 years and 20 years back, people did not think that in a growth market, value investing can work. But at ICICI, we believed in it, and the fund grew from 130 crores to 50,000 crore. Primarily because if everyone doesn't believe in value investing, you are in a lonely position, and therefore you are in the best position to take the long-term calls. Like in 2007, not bet on infra and bet on sectors like FMCG and pharma, which actually delivered huge returns from 2007 onwards. And in 2017, bet on large caps when mid caps were actually roaring. And in 2020, bet on sectors like telecom, metals, PSU, and those kind of sectors. So our belief has been that, we value investing will work provided everyone doesn't become a value investor. Luckily, it never happens because value investing in the near term is always a very, very painful activity. And like today, for example, not to believe in microcap, not to believe in banks, to believe in having more cash than before in the fund. These are all things which people find much more difficult than before. And so I believe that value investing is very tough in the near term. And that is the advantage that we at ICICI have had in running this strategy. And we believe that this kind of a strategy also has periods of time when it doesn't do well, like 2006 to 8, 16 to 18. And but at the same time, the long term looks is good because it does what is logical for investment, which is buy things cheaper than intrinsic value. And we have learned that over a period of time, you can't focus on gruesome sectors. You have to focus on sectors which have quality embedded, just like Warren Buffett also started to use Charlie Munger's thinking in his value style. We also started to focus much more on quality sectors over a period of time, sectors like pharma. Like today, for example, this year we bought a lot of consumer staple stocks in the fund and a lot of IT stocks in the fund because of this framework. So we believe that this is a long-term good investing thinking fund which can work with periods of underperformance. And that's what we see. But the near term is tough because the markets are not cheap at this point.
It's so fascinating that every time I interact with you, I mean, you just give us a new dimension that, don't chase what is popular because cherry consensus never gives you a bad price. Buy something which is ugly to your eyes, which is nobody likes, bit of banks, some staples. And thank you for joining us and walking us through that, what the whole value ideology of ICICI Prudential AMC is. Always wonderful to interact with you, Naren. And I'm surprised that we've always discussed Buffett and we'll always discussed Harvard Marx, but today we discussed Charlie Munger.
Yes, in honor of him. He has added to Warren Buffett in such a big way because Warren Buffett says, otherwise I would have been always doing cigar butt investing. And we also learned in the first 3 years of discovery, we were doing cigar butt investing. But in 2007, we ended up having too many gruesome sectors. And after that, we moved to a style which involved a lot of pharma, a lot of FMCG, a lot of IT, a lot of cyclical sectors bought at bottom. Because that was our learning and that was based on what reading we could do through the net on what Warren Buffett learned from Charlie Munger.
Yeah, that's another fascinating story, that buy a good business at a reasonable price. But Naren, I've always appreciated the fact that over the years I've interacted with you, I've learned so much, and the fact that you as a fund house and your managers, they keep on evolving, they keep on learning. The template is same, buy a good business at a great price, but the definition of how you evolve the investment process, that has changed so beautifully. So good luck, my friend, and thank you for joining us.
Thank you. Thank you.
All right, there you
If you like this video, then like, share and subscribe to ET Now.